March 2020 question. It is in front of you. Now, the requirement is here in front of you. The requirement is evaluate the financial acceptability of product key investment proposals based on chief engineer's forecast. Forecast. Assuming regulatory approval is granted in 1 year's time, 6 marks. The second one is calculate the expected net present value. Second part of the proposal based on the finance director's assumptions that about the likelihood of a recession and potential impact on project Chai's cash flows. Yes. Now, calculate the NPV of the finance director's alternative option of technology, advising the board whether this is worth pursuing or not. 3 marks. Recommend whether the board should proceed with the application of regulatory approval after taking into consideration Hathaway's 70% approval rate with its regulatory application, or to sell the concept to the G company. Include in your analysis any comments on your findings. Now, so this is a B part. We have not covered this topic. Rationale for capital investment monitoring system and post-completion audit. Although we can write a few things by reading it, by utilizing our common sense, rationale for implementing. 25 marks has 5 marks is for the skills of analysis and evaluation, skepticism and commercial acumen. No worries at all. So one by one, each part. So financial acceptability of project Chai. Yes. Project Chai. Investment appraisal. Yes. Now come here. Chai is here above. Or Chi, whatever you call it. Hathaway Company operates in the aviation industry, manufacturing safety equipment for the commercial aircraft. The company has a policy of carefully appraising new investment opportunities, including the detailed analysis of all costs and revenue assumptions prior to their approval. Hathaway Company's board is reviewing a potential investment product Chai. The company's engineers has developed a new technology which can detect the potential for mechanical failure in the greater degree of accuracy than previously been the case. Early test results have been extremely encouraging. Next. If the board accepts the engineer proposal, Hathaway Company would need to submit an application to the relevant regulatory authority. It is expected regulatory approval would be granted in 1 year's time. Manufacturing sales would commence immediately after being granted regulatory approval. Hathaway engineer presented an investment case in summary of the following costs and revenues. Very, very good, very interesting. Hathaway is expected to sell 3,000 euros in the first year, demand increasing by 5,000 over 4-year life. So project will continue for 4 years. The sales based on a contribution of $5,000 per unit in the first year, increasing at 2% per year, subsequently. Okay, fixed costs are expected in the first year and increasing 3% throughout the life. Investment of 12 million required as soon as the regulatory approval has been granted. Tax allowable depreciation is available on the at annual rate of 20% on straight line basis. A balancing adjustment is expected at the end of project when the plant or machinery will be scrapped. You need to be very much careful when reading it. And it is not for the sake of reading. We must be able to visualize while reading that where it can have an effect on the NPV performer. Now, tax is payable 20% in the year when profits are made. Relevant cost of capital can be used in the appraisal is 12%. Now, so just see here. So year 0, 1, 2, 3, and 4. And 5 as well. Why 5 year? I will tell you. They say that we need to do working as well here. Let me do here working as well. Now, so the first thing about working, that is about sales volume. Now, students, the point is, they say in 1 year time, regulatory approval will be given. In 1 year time, it will take 1 full year. It means investment will not be made now. So, and sale will start in subsequent year. So sale will start from year 2. 3,000 units. And first year of production with 5% increase later on. For 4 years. Like this. So unit will be a full unit. It cannot be a partial figure. Okay, now. So these are the number of units. Yes. And then they say contribution per unit. Which is 5,000 in the first year. And then later on, 2% annually. Yes, 2% increase every year. Contribution per unit. Now, total contribution. Total contribution. This into this. This is the total contribution. Annual. Okay. Now, so contribution will be here from year 2 to this. This is the contribution. Then they say that fixed cost of 8.7 million in the first year, less fixed cost. 8.7 million. Yes. It is cost increasing by 3%. Increasing by 3%. Next, the next point is, so fixed cost is there already. The next is taxation and depreciation. Tax allowable depreciation. So tax allowable depreciation. It's a 20% of 12 million. So 12 million is the cost into 20% every year. Same. Yes. Same. Final year, now it is 4 year, 20%. There is a balancing allowance. That is 12 million total value minus this, minus this, minus this, and minus this. Total charged. Yes. You see here. So balancing allowance, total capital allowance charged so far. So total capital allowance is equal to, here you go, 20%. They said that 20% straight line basis. So for 4 years, this is the charge. And in the fourth year end, the remaining. Next, the next point is, so less capital allowance. Anyone will tell me why we are deducting this capital allowance over here? Tell me. Anyone? Meanwhile, I will answer this question. They said that capital allowance is 20% on straight line basis. So 20% of total value. When you charge for 4 years, this is the amount. But after, still there is some value remaining. That will be additionally charged in the final year. This is charged, capital allowance charged in the 4 years. Okay. And the remaining will be charged in the final year. Still there is some amount. Trap value is 0. Okay. So total capital allowance will be this. Now, so capital allowance. No one answered my question. Why we are charging capital allowance here? Tell me. Yes, please. It is not allowed for tax purpose. No, it is allowed for tax purpose. That's why charging. To reduce, yes, this student responded well. To reduce the taxable profit and hence to reduce the tax payment. To save tax. To taxable profits that will be from here to here. Yes, these are the taxable profits. Less tax payments, which is 20%. Yes, just 20%. This into 20% in the same year. They said it is in the same year to tax payment. And now add back capital allowance. Add back capital allowance. We will add back, which is deducted. This one. The purpose of deduction above has served. We reduce taxable profit, we paid tax, now add back that. Simple is that. So investment, initial investment, that is how much? 12 million. It will be done after the regulatory approval is received in year one. Okay? In 1 year's time, they will get approval. The net cash flows of the project. Net cash flows of the project. Now, present value at the rate of 12%. We say relevant cost of capital. This into 1.12 raised to power minus yes, NPV. This is the net present value of the project. So we have done the calculation. The first part, financial acceptability, evaluate. Okay. So we have done this calculation so far. Yes. So evaluate the financial acceptability. So NPV of the project is positive. How much? It is 7.02 million around. So the project should be accepted. Evaluate. Project T. Yes. The second part, they say evaluate, calculate, sorry, the expected NPV of the proposal based on finance director's assumptions about likelihood of Yes, recession and potential impact on its cash flows. Okay, we will see what is the recession and impact. Yes, finance sector has raised the following objections and consequences to the chief engineer's presentation. The chief engineer cost and revenue ignored the possibility of recession. It has a probability 20% occurring. In a recession, the total present value 4-year production are likely to be 40% lower. Read carefully. The financiers also believe that there is an alternative mutually exclusive development opportunity based on the new technology, although this would still depend on it being granted regulatory approval. This alternative option, okay, so that is something, the next part. Okay, the point is, the point is, they say, focus everyone, 20% probability of recession. So what is 80%? So 80%, there is no probability of recession. Things will remain the same. 20% is the probability of recession. 80%, so 80% is the probability of things going the same. Okay, no recession. And 20% probability is that cash flow total present value will be 40% into present value of cash flows from year 2 to 5. So yes, 40% lower means there will be 60%. 40% lower. Here, be careful. So remaining is 60%. Okay, so the full chance is, yes, 80%. They will be full. Now, I am going to make an equation. Focus. First of all, present value of cash flows from year 2 to 5 equal to sum from this to this. I have just added inflows from year 2 to 5. Whatever they're saying. So now, as so expected present value of cash flows as per finance director's opinion. Sorry, opinion. Now focus. There is 20% possibility. So I'm going to make a equation. There is 20% possibility that cash flows will be 60% of this plus. There is 80% possibility that cash flow will be 100% of it. Total this. Same. Is that clear to everyone? This equation. Tell me. There is 20% possibility, 60%. 80% is that, the 100%, whatever we predicted. Is it clear to everyone? Tell me this equation. Good. Now, this is basically expected value. Yes. So this is expected present value of cash flow. So expected NPV, present value of cash inflows minus initial investment. This is initial investment. This is the expected NPV. Sorry, present value of that. No, not this one. This present value. Because it is in the year one. This present value. Now, this minus this. Just not doing this calculation correct. Just a minute, please. Equal to this minus 12 million into 1.12 raised to power 1.12 raised to power minus 1. Yes. $12 million. Yes. Now it's good. Expected NPV. This one. This is present value of investment, which is in year one. I hope this is clear to you people. It should have calculated the other way as well. It was a negative. Now here it is. Same. So I was doing another a negative. So negative, it was adding actually both. It's good now. So expected NPV, in both ways it is correct. You can do in any way. So the third is calculate NPV of the finance director's alternative option. Okay, what is the alternative option? This is the alternative option. So he also believes that there is an alternative mutually exclusive. What is mutually exclusive? You can take one out of these two, not both at the same time. Development opportunity based on the new technology, although this would still depend on it being granted regulatory approval. This alternative, again, depending upon regulatory approval. This option will incur identical investment, but generate annual post-tax cash flow of this over 7 years. From year 2 onwards. That is quite interesting. The third part, alternative option, NPV we need to calculate. They said that. Calculate NPV of the alternative option and advise the board whether it is worth pursuing or not. Advise. Now, so students, they say investment is same. Investment. And what they are saying, that is annual cash flow from year 2 onwards. How much it is? 3.43 million. Over its 7-year life, means from year 2 onwards, 7-year cash. So this cash flow will occur for 7 years. So present value of 7-year cash inflows. How? This into NOT fact. Delayed NOT. NOT starting from year 2 at 12%. 2 for 7-year NOT. 7-year NOT. I need to open an NOT table to find that. Just a minute, please. I need to find NOT table. Sorry, just a minute, please. It has opened another document for us. Okay. So NOT table is here. Yes, here it is. So 12% for 7 year, 4.564. 4.564 for 7 year at 12% into delayed NOT. It is NOT starting from year 2 if you have watched that video. So 1 year discount factor as well, 0.893. Present value of 7-year cash inflows. Yes. Now, present value of investment. Present value of investment. That is equal to 12 million. Again, into 0.893. 1 year discount rate. Or 1.12 raised to power minus 1. Same thing. So NPV. NPV. This minus this. Any question you can ask before I proceed? Yes. I suppose it is clear if no one is asking the question. Okay. What we did, we calculated present value of NOT, of cash inflows, then present value of investment, and then NPV. So the question was there, and why it is worth pursuing? No, it is not. It is having less NPV than the other option. So what finance director is saying, so the option given by finance director, the alternative option option will give less NPV by around this 3.2 million, this 5.6 million. It is 2.4 million. So 2.4 million. So it will give less NPV by around 2.4 million. So this should not be accepted. Be preferred over the proposal by chief engineer. The other is by chief engineer. Yes. Student, in this way, when you discuss, you get professional marks as well with the logic, with data, okay, on the scenario words. You could have written, a student may have written that this option is less attractive, having less NPV, so it should not be accepted. But it is not a professional way to discuss anything. Okay, now, so the next is recommend the board should proceed with the application for regulatory approval after considering 70% approval rate, or to sell the concept to GIPI and analysis as well, and comment on your finding. 5 marks. Here it is, the last paragraph, which is about it. Investment case assumes approval is certain. Up till now, we have been evaluating that approval is certain, but there is 70% chance. Historically, 70% Hathaway companies' applications have been approved. Yes, in 1 year's time, if the regulatory application is not approved, it is assumed that concept can be sold to GIPI for 1 million at that time. If the board rejects the project proposal now, assume the concept can be sold for 4.3 million. Read this line carefully. They say you have done the evaluation. Okay, well, you are saying NPV is very good, accept it. But when you get this NPV, when you get the approval, okay? So you are standing now, you have to apply for the approval. If you want to, if the board does not recommend going for this project, you can sell this concept and idea to GIPI for 4.3 million now. But if after 1 year, this application is not rejected, if regulatory approval is not obtained, it is rejected by authorities, then you can sell for 1 million. Focus. 4. The requirement is, yes, recommend they should proceed with or sell it. Okay. So, value of selling the concept now. That is 4.3 4.19 million. 4.3 million, sorry. 4.3 million. Yes. Okay. But if the company goes ahead with approval, what will happen? 70% chance it will be accepted, and 30% chance it will be rejected, and will have a value. How much? 1 million. 70% chance it will be accepted and it will have a value of this NPV you calculated above. This one. Yes. Now, with the recession, considering the recession, everything, 70% chance it will be accepted with a value and will give value. Considering the recession as well. We have not taken this full value. Why? Because there is chance of recession, so we'll take this value. Now, so expected NPV, focus. Expected NPV of this option with approvals. 70% chance that they will get this plus 30% chance that they will get this. If a company goes ahead, if they sell it now, both are compared. Which is giving highest value? This. This is giving the highest value. So value of selling is high. Now to JP for 4.3 million. Done. They said that there is another reason. Comments as well. Comments or analysis. You can give analysis as well. Whatever you want to write, because both words they have used. Analysis. Now, so students, now we will cover all this part. So, as per the chief engineer's proposal, the project will give how much NPV? 7.02 million. 7.02 million NPV. Which is much higher than selling to Gippy at 4.3 million. But there are chances of recession as well. So, considering that, considering that, and chances of rejection of application is also incorporated. So expected NPV is 4.22 million. Yes, but 4.22 million is expected value considering an average. If the decision to make same investment is repeated, again and again, which is not in this case, as this investment is only one-off. So 30% chances are that approval will not be granted. Yes, which is in which case the company will get only 1 million. Yes, in practice, and 4.22 is not attainable in this case. Yes. So the directors, if wants to be on safe side and the company will get about 4.3 million by selling the idea. But it all depends upon attitude towards risk of the directors. If they want to take the risk, sensitivity analysis should be performed on all variables included in NPV calculations. before making a final decision. Yes. You see how in-depth discussion can be done. Anyone, any question? Students, this second part, I can discuss it some generic things with you, although to the full-fledged topic. Capital, 4 marks it is. Explain the rationale for implementing capital investment monitoring system. Capital investment monitoring system and post-completion audit. Okay, come here. They say a recent board meeting discussed two recent investment, Project Lambda and Kappa, both involving the construction of new manufacturing plants for safety equipment. Both projects are now operational through, although, sorry, yes, Lambda experienced significant time delays. It is giving us the idea and cost overrun, the benefit of capital investment monitoring system. They're telling themselves, we have to explain them. Okay. So the first thing is significant delays. It is given in the scenario. And the second is cost overrun. If I show you, there are 4 marks for it. It means 2 marks are for this and 2 marks for this. For 2 marks, we have found 2 points on which we can write 2 lines each. Explain. Okay. And the second, one of directors suggested that Project Kappa. It is about Project Kappa. Was under budget and okay in lambda lambda delayed actually, sorry, and lambda delayed, kappa cost overrun. Okay, now one of the direct suggestions that they could benefit from introduction of capital and post completion, they agree to discuss in depth. Now, so what is capital investment monitoring system? It is basically continuous reviewing the project and its progress, whether project is as per its plan, time scale, within cost constraints, and if it deviates, so it can be fixed immediately. Measures can be taken if it is, so that's the benefit of monitoring system. So this effective monitoring, first we told generic. So effective monitoring would have avoided the delay in significant delay in lambda and cost overrun of project kappa. Okay, 2 marks done. Post completion audit, what is that? So post, once a project is completed, so its audit is done. The purpose of this audit is to identify the deficiencies in the investment appraisal, in the project implementation, till the final outcome. So all the deficiencies are identified. And any new successes as well are identified. The purpose is to avoid repeating the same mistakes in future and to implement the new learnings from the successes latest available, what we learned. Now, so now applying to, we must have to link it to the scenario. If you don't link whatever you are saying, you are telling principles, you will not get good marks. Minimum marks are awarded if you don't link what you are saying. So here, in the case of Hathaway, the project Kappa has overrun its cost. The reasons would have identified in the post-completion audit. And same is the case of delays in the lambda to avoid in the reasons in the future. To avoid reasons in the future. Yes. I hope it is clear to you people, students. Now, so I want to show you the marking scheme as well. I want to show you the marking scheme as well. Just a minute. It is very important to learn the marking scheme. Just a minute, please. Yes, here is the marking scheme. You see here, we have done the calculations. Tax allowable depreciation has 2 marks. Okay, because there was some difference. Expected NPV, decisions outcome discussion. Comments has 3 marks. Okay, and then 2 marks each, the both. Now 5 professional marks come here. Appropriate use of data to determine suitable calculation. In you are extracting the calculations. Appropriate use of data to support discussion and draw conclusions. Okay, key facts, challenging that. We challenged that these variables, so sensitivity analysis should be performed. Okay, yes. So, and we said that if it is repeated, then expected NP will be obtained. Effective use of example and calculation from scenario to illustrate points. So nothing is new. Other than what I have explained to you people. This is very much important to learn from. Okay, so all right, students, that's it for today.